We've been talking about markets entering a new cycle since the start of this year. And now, with strong US domestic demand, global trade recovery, and inflation coming down, we're seeing this come to life.
At the beginning of 2024, investors were riding high a continued equity bull run. And while there have been some bumps in the road from time to time, we still expect that run to continue, thanks to accelerating global growth.
But while that growth is good news, there are some forks in the road ahead. In the US, growth is slow but steady thanks to solid consumption and investment. For Asia and Europe, economies here are finally accelerating, driven by industrial recovery in China.
The big change to watch out for this year will come from central banks. They are expected to make a U-turn when it comes to rates. No more hiking, the focus for the rest of 2024 is cutting. When and where is unclear, but expect some moves.
If you are an equity investor, you can now tweak your portfolio towards more cyclical stocks. These are stocks that could do well when consumers and corporates are willing to spend and invest. Things like electrification and automation, industrials, but also mid-caps, as they tend to benefit from economic upturns more than the mega-cap space. When it comes to emerging markets, we still like India, South Korea, Taiwan, and Brazil. In Asia, investors should potentially benefit from both Japanese and, after a long time, also Chinese stocks. When it comes to fixed income, ahead of central banks cutting rates, it should be a good time to give your portfolio a once-over. Shorter-dated bonds could be gradually enhanced with those that mature later. We prefer quality corporate bonds over government bonds from developed markets. For those looking for potentially higher yields, emerging market hard currency corporates are our preferred option.
Geopolitics will remain a major headwind for the second half of the year. And although the US presidential election in November might cause some volatility in markets, we can cross that bridge when we get to it. Until then, investors should keep their wheels turning and stay the course.